welcome to ICICI Director. Joining us today is a special guest, Ms. Shalini Tibrewala, who will be joining us to talk to us about investing in the GM Corporate Bond Fund. The NFO is currently open and closes on the 7th of March. Before we go into the Q&A, Shalini has a short presentation on opportunities to invest in the GM Corporate Bond Fund. Shalini, over to you first.
Hi, thank you so much for sparing your valuable time. I have a small presentation which I'd like to put up, and we'll take it from there. So we are talking about GM Corporate Bond Fund, which we feel offers a very attractive investment opportunity in the current interest rate juncture we are situated in. So we have been in a very soft interest rate regime over the past 2 years, where central banks across economies and domestically also have infused liquidity to support the market on the COVID pandemic. But as we are moving towards a normalization phase, there are many parameters which where the central banks are facing issues of inflation and are in a normalization process. So where are we heading here from here now? That's the larger question at this point of time. When we look at the global markets, the central banks are all calling for rate increases, where Bank of England has already increased rates and Fed is treading on the path towards an increase. As a result, bond yields overseas have moved up. Now, when we look at our domestic market, where we have seen the 10-year move to 575, and it has moved to 6.9% post budget. This is largely on account of high levels of borrowings announced at the budget. We are seeing inflationary pressures, where the inflation has touched 6% recently, and crude is rising very sharply, more because of the Russia-Ukraine face-off. So where does this leave us? At this junction, where RBI has said in the policy that the main stance they are focusing is to support the growth locally, whereas there is an eye on inflation and what's happening. RBI has given a guidance of 4.5% on inflation for the next FY23, and they said they choose to not imitate central banks overseas, and they are going to support growth going forward. So what does one investor construe in this point of time, where the entire market says that the reverse repo rate should go up, repo should be hiked? When and how is this going to happen? So our outlook going ahead is that we expect that rates would move up gradually, but there is a certain timeline in which this would happen. And if the RBI is content with containing inflation within its band of 4% plus or minus 2%, and growth is on path, and they would like to actually just leave rates in the band of 3.75-4% if they can contain inflation, but all at this point of time is playing a spoil sport. So in the current scenario, what does an investor do? An investor has no clarity, visibility, what he should be looking to do in a medium-term perspective. So to tackle this and, to give an investor moderate kind of a returns, at this juncture, we have come out with the corporate bond fund. SEBI has, 36 categories of, funds which they have allowed mutual funds to float. Corporate bond fund happens to be one of those. Now, what essentially happens in the corporate bond fund? In the corporate bond fund, the fund necessarily has to invest, more than 82% of its securities in ratings above AA+. So the fund has very high liquidity because 82% is in AA+, AAA, and sovereigns, which gives an investor potential to give better risk-adjusted returns and liquidity. And the credit risk is very moderate in this fund. The essence of this fund is that, we are looking to, invest into a maturity of around 3 years to 4 years, and, roll down the maturity and try to hold it to that maturity where there could be some visibility in terms of returns. So the way we have structured this fund is that though SEBI allows us to invest, says that minimum 82% should be invested in AA plus and above. Our target is to invest minimum 85% in AA plus, including sovereign. We are targeting a maturity of around 48-50 months, and we like to go and try to hold on to that maturity. So we have put in a load of 0.50 basis points for those who redeem within 180 days. The essence is that we do not want large investors coming for tactical plays and disturbing the returns of investors who will choose to invest with us for a longer duration. So in this fund, it's an open-ended fund for a 3-year horizon, and long-term capital gain will be applicable on debt mutual funds if you hold for more than 36 months. And at this junction, since we are in the period of March 22, you could get an additional 1-year indexation benefit if one invests within this month. So why is corporate bond fund making a lot of sense at this point of time? Since the interest rate scenario is going to be likely very volatile, and we don't know when rates could move up. As we have seen by the policy, we do not feel for another 6 months rates could move up by the language of the policy. So should one hold on now and invest later, or what happens? So we have done certain calculations where we feel that if you invest right now, and you invest into a target maturity, so as interest rates go up, your maturity starts reducing, and this provides a natural hedge against your capital. So if we look at this is a typical example of a forward curve, where forward curve is pricing in what is going to happen in the next few years. So when we did an analysis of the forward curve, we could see that at least the curves which is currently, and the forward curve is implying that 80 basis point rate hike is already factored into the forward curve. So what should an investor do? Today, suppose we have an example. This is just an illustration that suppose the 4-year yield is at around 6.5%. Should we invest for 6 months and then lock in for 3.5 years, or should we wait for a year and then lock in for 3 years? So the answer is that if we look to invest into 6 months, then for the residual period, your 3.5-year yield should be at around 681 to match this kind of returns. And if we lock into 12 months now and take a view of investing into 3 years later, the forward rate which we will need to invest into is 7% to break even. So the forward curve is a very reasonable estimate of rates going ahead. Plus, if you put in investment now, you also pay short-term capital gains, making it unattractive, and you are losing indexation benefit also at this point of time. Hence, investing now rather than postponing your investment decision would be a prudent strategy to follow. I'd also like to cover a point where if you invest now, what happens to your effective tax rate. So as per the workings we have done, and if you stay invested for a period of 4 years, your effective tax rate comes to around 5 to 6% only. Ultimately, this is a win-win situation, and the kind of returns you would generate in this fund you will need to invest at a pre-tax rate of around 8.25% if you are in the 34-35% tax slab. So this is the product offering we had in mind.
Thank you, Shalini, for that. That was a very extensive presentation, helping our viewers understand the rationale behind the GM Corporate Bond Fund and why it is a good time to make investments in the debt markets. Shalini, firstly, you went through that presentation. It was fairly extensive, like I said, but just for the sake of our viewers and for a better understanding, time-wise, is this an ideal time, or would you recommend investors to wait it out for the next 5 to 6 months when there is indication of an increase in the rate cycle?
Yeah, so Samina, as I said, we don't know when the rates, cycle would move up. That is number one. And if you look at the policy has been benign. It is supporting growth. And if you look at the GDP numbers, the GDP growth for Q3 was at 5.4% versus a consensus of 6%. And considering, what's happening in the geopolitical situation, RBIs and central banks world over would support the economies. So we feel that interest rates cycle moving up is postponed slightly at this junction. So it really makes sense. And as we have this calculation in front of us, it could, happen even after a year. So you have loosed out on carry, the differential carry for the intermittent time. And even when rates go up, we do not know what the magnitude is going to be.
And I think some amount of indexation as well, if investors make the investment during
in March.
Shalini, talk about the product itself. What is the strategy of the portfolio for this fund? What are the sort of allocations the fund manager will be making to?
So as I said, that instead of 82%, which is mandated by SEBI, we will look to invest minimum 85% of our portfolio in securities rated AA plus and above. So though it's an open-ended fund, we'd like to, make adjustments and in our portfolio and try to, enhance the returns by playing on spreads at this junction. So if suppose we are giving you an example, if we have invested, say some security at AAA and we find, a good spread, with a good credit on AA plus, we could switch within those ratings as well and improve the performance of this fund. So it's not going to be a total, passive strategy. It will be an active strategy, but it will be within the rating mandate only.
Shalini, we do all understand that one of the benefits of investing in the debt market is the advantage of indexation. But from a tax angle, help our viewers understand what are the taxations that will be levied upon the returns generated by this fund?
So what essentially happens in units of mutual fund held in debt schemes, anything which is held for less than 36 months is classified as short-term capital gain, and it is subjected to the individual's tax rates in the category they fall into. But whenever you hold a security for more than 36 months, it qualifies for long-term capital gain and you get indexation benefits. So and the tax rate is at 20% plus surcharge and cess, depends on again in the tax slab the investor falls into. So if, we had just done a calculation, a simulation that, if an investor invests at this point of time, and suppose, an investor gets a return of, say, just for an example, say 6%, then his effective tax rate is an absolute 5%. Which is, a very reasonable rate of tax to pay.
No, you've got a fair point. Especially investing in the debt market through debt mutual funds is a far more efficient instrument, especially from a taxation angle. Very lastly, Shalini, and this is more of a broad question, there is enough and more uncertainty in the global setup. You look at crude prices, look at rising inflation, talks now about a fourth COVID wave, Russia, Ukraine, to say the least. And the context, what I'm really trying to build here is equity markets have been under pressure. What is it looking like for the debt market? Is the fixed income market looking a lot more promising? Where are you seeing rates headed? I do remember during the budget was when we saw G6 around 7%. Very soon after the monetary policy, those declined once again. From where we stand, what is the outlook on the fixed income market?
So, we are also, treading a cautious part on the fixed income market, because at this current stage, what's disturbing the market is the huge supply overhang, which is going to come in the next fiscal. Of course, RBI has, projected 4.5%, on the inflation, but oil is going to play a very big spoil sport. We do not know how long this pace-off is going to continue, and energy prices are going to remain elevated. So that's the scenario which, we are looking forward to, but we are quite optimistic that, the revenues which have been projected in the budget by the government are more on the conservative side. And if we look at, direct and indirect collections, which have come in the recent past, are looking promising. We also expect that, the small savings which have been projected are on the lower side, and RBI should be able to, support the government in the budget, in the borrowing program largely. So the market is looking for that, what kind of support the RBI is going to give the government in the borrowing program. If that comes through, I think largely, we should be able to sail through the government borrowing program smoothly. Yes, rates look to, move slightly on the upper side, but it's still a while to go for 6 months or so. So there's a lot of uncertainty, but we should be able to tide over these uncertainties.
Well, it looks like the year could be a difficult one. But thank you, Shalini. Great talking to you today. That was everything you need to know about the GM Corporate Bond Fund. The NFO is currently open. It closes in on the 7th of March. So if you are looking to make that investment in the debt market and take advantage of an additional level of indexation, right now might be a good time to make that investment. Thank you, Shalini, for joining us on the show today.
Thank you. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.